Bitcoin always plays dead before the breakout. And the problem is, if you misread this phase, you don't just miss upside, you lock yourself out of the cycle that actually matters. Right now, the price is hovering under 6 figures, momentum feels fake, volume feels thin, and if you zoom in too closely, it looks like nothing is happening. That's exactly when most people make the wrong decision because the real catalyst isn't loud, it doesn't spike the chart, and it doesn't show up in your notifications. It shows up quietly, months before price reacts, and if you don't understand what it is, you'll think Bitcoin is broken when it's actually being positioned. Here's the part that should make you uneasy. The most important Bitcoin shift of the next cycle isn't coming from halving math, or ETF inflows, or even rate cuts. It's coming from a structural change that most investors won't notice until it's already priced in, and by then, reacting will be too late. If you've ever watched Bitcoin stall for months and thought, this time feels different, you're not wrong. But not for the reason most people think. Let me put you in the moment. Price pulls back. Headlines say manipulation. Social feeds fill with arguments about whether the cycle is over. You're told to be patient, but patience feels passive. And meanwhile, the people who actually move size are doing something very specific. They're not trading. They're not panicking. They're setting rules. That's what this video is about, not price, not hype. The rule changes quietly happening behind the scenes that turn Bitcoin from a speculative asset into infrastructure, and why 2026, not tomorrow, not next month, is when the consequences finally hit the chart. Most people hear that and think, so I just wait? No. That's the trap, because waiting without understanding leads to selling at exactly the wrong time. Bitcoin doesn't explode out of excitement. It explodes after boredom, after disbelief, after months where nothing seems to work and narratives fall apart. Every major breakout has looked like a failure right before it wasn't. Think back to previous cycles, not the peaks, the flats, the stretches where price moved sideways, volatility dried up, and everyone started searching for reasons it wouldn't work anymore. That's always when the foundation gets poured. Here's what's different now. In prior cycles, Bitcoin was waiting for acceptance. This time, it's waiting for integration. That sounds subtle, but it changes everything. Acceptance is when people argue about whether something should exist. Integration is when institutions quietly assume it will, and start building systems that depend on it. You don't get fireworks at that stage. You get paperwork, you get policy drafts, you get slow, boring statements from people who don't care about price charts, but control capital flows. That's what most investors tune out, and that's why they miss the signal. Right now, institutional adoption isn't about buying spot Bitcoin and posting about it. It's about who gets to custody it, who gets to issue products against it, who gets regulatory clarity to build on top of it, and who gets shut out if they wait too long. Price lags that process, always has. So when Bitcoin looks like it's playing dead, ask a different question. Who is still accumulating when nobody is cheering? Who is expanding exposure when volatility feels uncomfortable? And most importantly, what has to be true for them to be doing that? Because institutions don't speculate on vibes, they position for inevitabilities. Here's where discovery starts to matter. A lot of people think institutional adoption already happened because ETFs exist. That's surface level thinking. ETFs were the door opening, not the crowd walking through. The real shift starts after the door is open and firms realize they can't stay on the sidelines without risk. Risk isn't just losing money. Risk is being irrelevant. Banks don't fear Bitcoin going to zero. They fear clients asking why competitors can offer services they can't. Asset managers don't fear volatility. They fear missing allocation mandates. Governments don't fear price swings. They fear capital flight and losing strategic influence. That's the environment Bitcoin is entering now, and it creates a strange phase where nothing looks bullish, but everything is being aligned. Let me slow this down, because this is where where people get lost. Institutional adoption doesn't happen when prices are euphoric. It happens when prices are stable enough to build around. You can't structure multi-year products on top of chaos. You need predictability, even if it's boring. That's why Bitcoin often flatlines before massive moves. Stability invites builders. Builders invite capital. Capital invites repricing. The repricing is the last step, not the first. Now here's the uncomfortable truth. Most retail investors are trained to look for confirmation in price. Institutions look for confirmation in policy. And policy moves on a completely different timeline. This is where 2026 comes into focus. Not because of a single event, not because of a magic number, but because the groundwork being laid now has a delayed effect. Think about how regulation actually works in the real world, not the way it gets summarized on social media. It starts slow. Painfully slow. Drafts get written not to make headlines but to survive legal scrutiny. Every word matters. Committees debate language for months because a single sentence can change who's allowed to participate and who gets shut out. Nothing moves fast here, and nothing is designed to be exciting. Then agencies step in and interpret those mandates. Not emotionally, not ideologically, practically. They decide how rules apply in real situations, what counts as custody, what counts as reporting, what's allowed, what's restricted, and what needs clarification. That process alone can take years. After that, firms adjust. Compliance teams rewrite internal policies. Legal departments stress test edge cases. Risk teams decide how much exposure is acceptable and under what conditions. Infrastructure providers step in to build systems that meet those requirements. Custody solutions get approved. Settlement processes get standardized. Auditing frameworks get implemented. Then products get tested. Quietly, in controlled environments, with limited exposure, with fallback plans. Nothing flashy, no mass adoption yet, just proof that the system works under pressure. Then, and only then, clients get educated, not through hype, but through documentation, through disclosures, through conversations that start with risk, not upside, through months of internal training so advisors don't make promises they can't keep. None of that pumps price. None of it trends. None of it feels bullish in the moment, but every single step removes friction. And friction is the real enemy of capital. So capital doesn't hate risk. Capital hates uncertainty it can't model. Capital hates unclear rules. Capital hates operational chaos. Capital hates not knowing who's responsible when something breaks. When friction disappears, capital doesn't need persuasion. It doesn't need excitement. It doesn't ask for permission. It flows where it's allowed to flow, because that's its job. That's why this matters to you, even if you're not running a bank, managing a fund, or sitting on an investment committee. Because when institutions finally move in size, they don't chase price the way retail does. They don't look at charts and ask if something is overbought. They allocate. And allocation fundamentally changes market structure. Allocators don't buy dips and sell rips. They buy exposure. They decide what percentage of a portfolio belongs in a given asset. They commit to mandates. They rebalance on schedules, quarterly, annually, over multi-year horizons. They think in decades, not candles. That shift is everything. That's how a market evolves from violent volatility to slow, relentless repricing. Not because speculation disappears, but because it gets absorbed by larger, steadier flows. Bitcoin doesn't stop being volatile overnight. That's unrealistic. But it does stop being ignored. It stops being optional. It stops being treated like a side bet. And that transition feels wrong if you're used to excitement. It feels slow. It feels controlled. It feels manipulated. It feels like nothing is happening when you're watching price every day. It feels dead. But dead is exactly what Bitcoin needs to look like before it becomes infrastructure. Infrastructure isn't exciting. Roads don't pump. Power grids don't trend. Payment rails don't go viral. They just work. And because they work, Everything else builds on top of them. That's the phase Bitcoin is moving toward. Now let's talk about something nobody likes to hear during this phase. If you're constantly checking price, you're playing the wrong game. That doesn't mean price doesn't matter. It always matters, but it means price is a lagging indicator. It reflects decisions that were already made elsewhere, often months earlier. Right now, the most important decisions aren't being made by people staring at charts. They're being made in conference rooms without price tickers on the walls. They're being made by people asking very different questions. What happens if we don't have exposure? What happens if our competitors do? What happens if this becomes standard and we're late? Those questions don't lead to trades. They lead to policy changes. They lead to long-term positioning. They lead to quiet accumulation that doesn't care about short-term price action. That mindset is completely different from retail speculation, and it produces a completely different outcome. Here's a useful reframe that changes how you see this entire phase. Bitcoin isn't trying to convince anyone anymore. It already did that years ago. Now it's being evaluated. Evaluation is quiet. Evaluation is slow. Evaluation is methodical. Evaluation doesn't trend on social media because it doesn't generate excitement. It generates checklists. But evaluation is what turns an asset into a standard. Standards don't need hype. Standards don't need influencers. Standards don't need constant validation. They need acceptance. They need reliability. They need enough people to assume they'll still be there tomorrow. Now, here's the uncomfortable part most people won't say out loud. There will be stretches where Bitcoin underperforms expectations. Long stretches, there will be times where other assets feel more exciting, faster, louder, easier. There will be moments where narratives shift away from Bitcoin and toward whatever feels new or shiny. That's not a failure. That's absorption. As the capital base grows, it becomes harder to move quickly. That's not manipulation. That's physics. The bigger something gets, the more energy it takes to move it. And yet, every cycle, the same pattern repeats. The longer Bitcoin consolidates, the more explosive the repricing becomes when friction finally gives way. Because by the time it moves, the foundation underneath it is far stronger than people realize. This is the fork in the road. This is where people either zoom out or they tap out. They either understand what phase they're in, or they assume something is wrong because it doesn't feel exciting anymore. And this is where I need to insert something important, because how you hear all of this matters more than the information itself. This might shock you, but I'm not a financial advisor, and nothing in this video is financial advice. Cryptocurrencies are highly volatile, and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. And this video is for entertainment and educational purposes only. Now that that's clear, let's keep going, because the real insight comes next. If you've been around long enough, you've seen Bitcoin die more times than you can count. Media declares it over. Analysts explain why this time is different. Commentators say adoption stalled. And then, quietly, the base forms. What's different this time is who's building that base. In earlier cycles, it was mostly individuals and early adopters. This time, it's institutions building rails, custody solutions, compliance frameworks, lending products, and allocation strategies. Right? That doesn't feel exciting, but it's irreversible. Once institutions integrate Bitcoin into their systems, backing out isn't a trade. It's an operational failure. That's the asymmetry people underestimate. Retail can sell in a click. Institutions unwind over years, if they unwind at all. That's why accumulation during boredom matters more than accumulation during hype. And that's why the idea of Bitcoin playing dead is so misleading. It's not dead, it's dormant, and dormancy is a sign of strength when you understand what's happening underneath. Let's talk about timing without predicting price, because this is where people get themselves into trouble. 2026 isn't important because something dramatic happens on January 1st. There's no bell that rings, no announcement that flips a switch. It matters because by then, the decisions being made quietly right now stop being optional. They start producing consequences, whether anyone is emotionally ready for them or not. That's the part people underestimate. They think markets move when news breaks. In reality, markets move when systems finish adjusting to decisions that were already made months or years earlier. Think about how institutional policy actually turns into capital deployment. Not in theory, but in practice. First, there's internal approval, then there's legal review, then risk committees, then compliance frameworks, then custody solutions, then pilot programs, then position sizing, then allocation schedules, then reporting requirements, then finally, capital starts moving in size. None of that happens quickly, none of it is exciting, and none of it shows up on a chart while it's happening. There's always a lag. Always. That lag is where we are right now. And this is the most psychologically dangerous phase of the cycle because nothing feels resolved. The bullish narratives feel early. The bearish narratives feel loud. Price doesn't confirm either side. So conviction starts leaking out through impatience. This is where most people talk themselves out of their own thesis. The temptation is to assume that nothing is happening because nothing feels urgent. No emergency, no countdown, no pressure. But urgency is a retail emotion. Institutions don't move because they feel something. They move because something becomes inevitable. I want you to sit with that word for a second. Inevitable. Institutions don't need Bitcoin to be exciting. They need it to be unavoidable. They need a moment where not having exposure becomes riskier than having it. That moment doesn't arrive with hype. It arrives with alignment. Once enough inevitabilities stack up, price has to respond. Not because people are celebrating, not because headlines turn positive, but because capital runs out of alternatives that offer the same combination of properties: liquidity, portability, scarcity, neutrality, global settlement, no counterparty risk. When capital looks around and realizes that nothing else checks those boxes at scale, flows change, slowly at first, then all at once. That's the real catalyst no one likes to talk about because it doesn't make for a clean narrative. It's not a single bill. It's not a single ETF. It's not a single election or rate decision. It's a convergence. Clarity gets established. Access becomes normal. Custody gets standardized. Regulation stops being a threat and starts being a framework. Demand stops being speculative and starts being structural. Those things don't explode into the market, they compress it. And compression is uncomfortable. Compression feels like manipulation. It feels like stagnation. It feels like wasted time. But compression is pressure building, not pressure releasing. When all of that aligns, Bitcoin doesn't need marketing. It doesn't need believers to convince anyone. It doesn't need promotion. It simply gets repriced to reflect the reality that has already formed underneath it. And repricing doesn't ask if you're ready. It doesn't care if you were waiting for confirmation. It doesn't wait for sentiment to improve. It just adjusts fast because it has to. That's why people always say the same thing afterward. They say, it moved too fast, or I didn't think it would happen like that, or I was waiting for one more pullback. Repricing doesn't negotiate. So what do you actually do with this information? You don't try to trade it. You don't try to time the exact moment. You don't sit there refreshing charts looking for permission, and you definitely don't panic just because it feels slow or boring. Instead, you change how you interpret quiet. Quiet isn't bearish. Quiet is unresolved tension. Confusion is what shakes people out, not downside. Confusion makes you doubt your own reasoning. Confusion makes you overreact to noise. If you understand why Bitcoin looks the way it does right now, you stop expecting it to entertain you. You stop needing it to validate you every week. You stop asking it to perform on demand. You start expecting it to do what it's always done in these phases: absorb disbelief. Let weak narratives fall away. Let strong structures lock in. Let impatient capital exit. And then, when the system is ready, move. And when it moves, it won't give warnings. There won't be a polite transition. There won't be a long announcement phase where everyone gets comfortable. That's the part people regret later. Not because they didn't know something was coming, but because they underestimated how quietly it was being prepared. They'll say, I knew something was coming. I just didn't think it would happen like that. It always happens like that. The breakout never feels earned while you're in it. It only feels obvious in hindsight. Before it happens, it feels wrong. It feels delayed. It feels suspicious. Bitcoin plays dead because it has to. It needs time to shed noise and harden structure. It needs to let speculation cool so allocation can begin. It needs to stop being debated and start being assumed. By the time the catalyst is obvious to everyone, the positioning is already finished. The real decisions are already locked in. If you want to stay ahead of that, stop watching for fireworks. Fireworks come at the end. Start watching for silence. And if you want to keep learning how these cycles actually work, subscribe or watch the next video.